Markets busy preparing for whatever the Fed does this week. I'm joined now by Kristina Hooper from Allianz Global.
Thank you for having me.
Well, the markets have been poised for this Fed meeting for some time, and it seems that we've gone back and forth on what exactly is going to happen. So let's start there. What are your expectations for the meeting?
So our expectations are that we're going to see some very robust debate. What we've seen over the past few weeks is a dramatic improvement in economic data. The first quarter was written off, and the second quarter began with a very slow start. And we could see it if we chart the Atlanta Fed GDP Now model. It was predicting, up until a few weeks ago, 0.8% growth for the second quarter. It's gone up to 1.9%. So a pretty significant increase just because of some recent economic data inputs. So things like retail sales we've seen, things like the May jobs report, also data points like just improvement in labor in general, the JOLT survey. So all those things are contributing to a much more improved economic outlook for the second quarter and beyond. So the debate is going to be the hawks versus the doves about just how much the recovery has improved in the second quarter. But it's also going to be counterbalanced with concerns about international issues, for example, the recurring Greek crisis and what that could mean. We've also, in the interim, heard from both the heads of the IMF and the World Bank asking the Fed not to raise rates this year. So while there's probably not going to be a lot of specific talk about those requests, what we will expect to see is a lot of robust debate about what a potential rate hike will mean.
So there's a lot of debate, but does that also mean there is enough outside concern that the Fed will just sit tight and maybe wait until September?
Our expectation is that it's most likely the Fed will wait until September. However, we do expect the Fed to act before the fourth quarter. So September should be the sweet spot. Everyone's back from summer break. It's a good time to start and really do an initial liftoff and be able to watch and digest it. And keep in mind, that's what the Fed is very focused on. They've stressed that they're not just data dependent when it comes to the initial liftoff, they're data dependent when it comes to the path of rates. So our expectation is they're going to raise rates once and sit and watch markets digest it, the economy digest it, and then decide where to go from there. We think they're in a hurry to do the first, but not necessarily the subsequent rate hike.
So what happens to the markets, do you think, between now and that September meeting?
So they're in something of a holding pattern with a fair amount of volatility. And that's our expectation that we've had for a while, that with the end of QE and the closer we get to normalization, we'll see more volatility, more differentiation among individual stocks that are standing now on fundamentals as opposed to monetary policy. We also expect rotation among styles, among asset classes, among market capitalization areas as well, because this is an environment that's changing very, very quickly. Market participants are processing inputs fairly quickly and in some cases making knee-jerk reactions to them. Greece is just one example of that, but there are a variety of different inputs that really could create some level of rotation in markets.
So what do you think the rotation will lead to in terms of what sectors might you be more bullish on now, even beyond September?
So, well, let's put the rotations aside because they're moving rather rapidly. And if we chart rotations, it's amazing how quickly we see changes in momentum and valuation among sectors. But looking a little longer term, where we see a lot of opportunity is technology. That's an area where they've been able to deliver earnings growth above and beyond the overall market. And that's a hard thing to do right now, particularly top-line growth. We certainly saw a first quarter where many met earnings expectations, but not that many met top-line growth expectations. So technology is one of those areas.
Old school technology?
All different kinds of technology for different reasons. Okay. So some tech has been able to meet that top-line growth. Other tech has delivered very attractive dividends and continues to grow those dividends. So it's a nice microcosm of the economy in a lot of ways because technology has different things to offer to different investors. Healthcare, now that's also a very big sector. It casts a wide net. Some areas we're more excited about than others, pharma, biotech right now. But there are a variety of different industries within healthcare that are delivering significant, not just earnings growth, but top line growth. So that's an area to focus on as well. And then, of course, even though valuations have gotten stretched in consumer discretionary, we think there's still some potential there. And perhaps an interesting play could be the lower end retailers, because we're finally seeing that comeback in the lower income consumer. They haven't necessarily participated as much in this recovery over the past few years. They're starting to participate more, and all the minimum wage laws we've seen, as well as the increases among large retailers, have helped them.
All right, Kristina Hooper, good to see you again.
Thanks for having me.
I'm Rhonda Schaffler for The Street.